Did you know that 90% of investors underperform the market, often because they make emotional decisions during volatile times? Or have you ever felt overwhelmed by wild market swings, unsure of when to buy or sell? If so, this video is for you. Welcome back to Simply Money. Let's talk about dollar cost averaging, DCA, a simple yet powerful investing strategy. Whether you're just starting or looking for a smarter way to handle market volatility, this approach could completely change how you invest. One of the biggest mistakes investors make is trying to time the market, buying low and selling high. Yeah, it's everybody's dream to buy Nvidia when it was IPOing or when it was just really low, and then selling it when it's high and doing that on a cycle and just making all this money. But the reality is 90% of people underperform the market because of timing. The problem, even professional traders struggle to do this consistently. For example, studies show that investors often sell during market lows and buy during highs, which locks in losses and prevents gains. The very opposite of what you want to do, the very opposite of what you go into it saying you're going to do, but the emotion gets hold and you fear, so you sell. Then you see something rising, you get excited and greedy, so you buy. Warren Buffett says, when people are fearful, get greedy. When the market's down, that's when you should buy. When people are greedy, when the market's going up, is when you should be fearful and not buy or sell. But he says not buy. The point being is we are very opposite in our behavior from what we think and know we should be doing with the stock market. Market volatility makes it tempting to react emotionally, but this often results in missed opportunities and unnecessary losses. When people say, I've lost money in the stock market, I always respond, no, you haven't unless you sold it. Market may be down, your portfolio may be down, but you haven't lost any money because it's still all there. If you have 100 shares and they were worth $150 each, and now they're worth $130 each, you still have 100 shares. And guess what? Be patient, wait. That'll go back up above the 150. In the long term, it always does. If you're diversified, you don't have to worry as much either, because one stock doesn't dictate how your portfolio is doing. Does a diversified portfolio still have downturns? Absolutely. They have big downturns. S&P 500 can lose 50%. Just go look at March 2020 during COVID. But those are usually short-lived and they rebound and then they go to new highs. It is okay. Volatility is normal. But one way to overcome that is dollar cost averaging. Trying to predict the market is a game most investors lose. That's where dollar cost averaging comes in. It eliminates guesswork and helps you stay consistent. One of the big things investors are missing, and the reason why so many people are struggling to build their net worth and get to a place where they can retire, is consistency. How does dollar cost averaging actually work? Well, the concept is simple. You invest a fixed amount of money at a regular interval, regardless of market conditions. For example, if you invest $500 monthly into an index fund, you'll buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. What are the benefits? Well, one, it reduces volatility's impact. You don't have to worry about market highs or lows because you're always buying. It avoids emotional decisions. By sticking to a plan, you remove the fear and greed that lead to costly mistakes. Let's just say on the first of the month, doesn't matter if the market's way down or the market's way up, you're buying. And next month, it might be the total opposite. Your plan is to whatever amount you set, on whatever time frame you set, to buy consistently and to hold for long term. Another benefit is building discipline. Regular investing creates a habit that builds wealth over the long term. And this strategy works especially well for long-term investors. And that's all we're about here at Simply Money. We're not here trying to tell you how to invest for tomorrow. or invest for a year from now. We're here to teach you how to invest for long-term, 10, 20 years from now, how to build long-term wealth, how to get out of debt, how to manage your money, not how to get rich quick. If you're looking for a get-rich-quick scheme or get-rich-quick plan, you're in the wrong place. We're slow and steady here. We believe in the 7 to 11% returns. We're not trying to beat the market and outsmart Wall Street. We're simply trying to be consistent, disciplined, and build our net worth and our wealth. And there is a way to do that without undue risk. Let me share a real-world example. Imagine someone who invested $1,000 every month in the S&P 500. Now, I know you might be saying, I can't invest $1,000. This is an example. The compounding, the work, the building of wealth is the same, whether it's $100 or $10,000. We're just showing the ability to be consistent on what it does. So we're using a $1,000 a month example in the S&P 500 from January 2000 to December 2020. Now, over those 20 years, they experienced two major market crashes, the dot-com bubble and the 2008 financial crisis. We're not going to include the March 2020 COVID downturn because it was so quick. It was 2-3 months and it was back to where it was, if not higher. But there was two big market crashes, the dot-com bubble and the 2008 financial crisis, the housing market crisis. But by sticking with dollar cost averaging, they turned a total investment $240,000. It's $1,000 a month for 20 years, $240,000 that they invested. That's a big investment. But it turned into over $600,000, even with all the ups and downs. And this proves that consistency beats timing, and staying the course pays off over time. It's about long term. I encourage you to read The Psychology of Money. I've done a video on that. It's on the channel. There's also a link in the description below. You can grab a copy of the book. It's an incredible book. It changes how you look at money, and it helps you understand your mindset currently, because your investment plan has to keep in mind your mindset. If you're going to freak out, if you're going to sell every time the market dips, you need to get a different plan. Maybe you do need to turn over some of that to somebody else, or to get a partner or a friend or somebody that can hold you accountable and talk you down off the cliff when the market's going down, and to keep you under control when the market's going up, that you're not just shoving money in on the highs thinking, oh, this is the next big thing, when it's already hit its peak and then it's dropping. We have those tendencies. So dollar cost averaging is a game changer for investors. It simplifies investing, it reduces risk, and it helps you stay consistent regardless of market conditions. Remember, the key is to keep investing regularly and avoid reacting emotionally to short-term volatility. Hey, I watch the market daily. I watch my portfolio drop $10,000, $50,000. I don't like it. I'm not sitting there going, oh, great, I just dropped $50,000 in my value. But I have the mindset when I see that, I'm like, it's down. Let me see if I can find some more assets, some more liquid assets that maybe I can throw a little bit more in there, because I see it as a sale. But the way I got there was I've been dollar cost averaging for years. Be consistent, and you too will get to that financial freedom you're looking for. Have you tried dollar cost averaging? Share your experience in the comments. I'd love to hear how it works for you. And don't forget to check out my other videos on the channel. Hit that like and subscribe button. It's free. It doesn't cost you anything, and it helps us get this out to other people. Dollar cost averaging, how you deal with volatility. And we'll see you next time on Simply Money.